Gary, thank you very much. Stocks rallying for the second consecutive day. Let's take a look at where the markets stand at this very moment. The Dow up 231 points, the S&P up 27. That's better than 2%. And the NASDAQ, look at that, up better than 3% or 72 points at 2417. So will this trend continue? And where's the safest place to put your money now? Brian Jacobson, Wells Fargo Advantage Fund's Chief Portfolio Strategist. Mark Lamkin is Lamkin Wealth Management CEO and CIO as well. Mr. Lamkin, you're 70% plus in cash and have been for the past 3 months. That's a position that's treated you reasonably well, I presume. What would get you to change that stance?
You know, I'm getting cautiously optimistic right now. I mean, the bottom line is the S&P 500 is going to have record earnings this year, and will be even higher next year. So we're cautiously optimistic right now. I think what clients are suffering from right now is a crisis confidence, not an economic crisis or economic recession. And I think right now I'm going to look for positive money flows. I'm going to look for insider buying. I'm going to look for less volatility in this market. And then we're going to start dipping our toes in. We're starting to buy cautiously right now.
What? What? Did we say that?
We all said that.
Did we all say that at the same second? What are you buying right now, Mark?
Well, I think we're going to be in a trading range for the near term based on this super committee. If they come up with 1.5 trillion or more, I think we're going to run. But I don't think they're going to do that. So right now, I'm looking at like the Barclays High Yield Index ETF. That's 8% plus right now because I want to earn yield right now. I think you can look at PowerShares Senior Bank Loan Index right now. It's adjustable rate. They're selling for 90 cents on the dollar. I think I can get some nice cap appreciation there. And let's face it, mega cap dividend stocks right now may be yielding 3 to 3.8 with a 10-year Treasury at 2%. And I do like that. That's all. Even if earnings get adjusted down, you're still yielding more than that 10-year Treasury, and that's always pretty good value right now. And we're dipping our toes in that right now.
Brian, you say that the market is overestimating the probability of a recession. You know, does it make a difference if we're in a slow patch or a recession? I mean, it seems like the economy is slowing no matter what. How do you invest in light of that?
Well, even though the economy might be slowing, I don't think that we're going to be seeing a negative print on GDP anytime soon. My forecast for the balance of the year is that we'll have perhaps 1.5% growth in the third quarter, 2.9% in the fourth quarter. So for the full year, that would bring us to about 1.5%.
2.9 in the fourth quarter? How are we going to get there?
Well, part of it could be due to a little additional stimulus or kick from the Fed. But also, I think that what we're going to see is a little bit of cannibalization of growth from first quarter 2012 coming into fourth quarter with the expiration of some favorable tax credits for capital expenditures. So I think that 2.9% will see that acceleration, but some of that's going to be at the cost of growth in the first quarter of next year.
Mark, you mentioned that you're watching the political arena and what cuts will be made and how much savings will be achieved. Does what Mr. Bernanke, though, has to say on Friday affect what you'll be doing in this market at all?
You know, it will. And I think, don't forget last year, the market had sold off in the summer 16 to 17% based on unemployment and European debt fears. And here we are again. Last year, Ben Bernanke announced his QE2 at this time. And the markets rallied solidly, and so does the economy. I don't think we're going to get QE3, but I do think he's going to lay out a few plans and maybe be somewhat dovish. But I get back to the super committee. I think that's going to be the catalyst this year.
Okay,
I think
so
they're going to come back.
You would not invest, I'm sorry to interrupt, but you would not invest ahead of Friday's address by Mr. Bernanke.
We're not. We're going to keep our 70% plus cash position until Friday. The majority of that probably until I get some answers from the super committee, because if they get less than 1.5 trillion, and I don't think they will, but if they get less than that, get your Dow 10,000 house, because here it comes.
But then is a 1.2 trillion in automatic cuts kick in if they don't get that? They don't come in at 1.5?
It will, but most of those cuts don't come to 2013. And I think, you know, at $3 million a minute on our national debt, people are tired of that, and the market's scared of that. I think they really need to come back with 3 to 4 to 5 trillion.
Brian,
and there's a possibility they do that.
Brian,
and if it does, it sets the stage.
Back to you. Talk to me a little bit about fixed income at these rates. Where do you go if you want yield? It can't be into treasuries.
Sure, and actually I think that it's a mistake to be sitting in cash. It's really expensive to be in cash right now if you think of the opportunity cost. You could have been sitting in something with a little bit longer duration, a little bit more credit risk, and clipping coupons. We think we're in the coupon phase of the business of the fixed income cycle right now, where you may as well stretch for a little bit of yield, provided you're doing the credit research to support that, because you don't necessarily want to just be investing in whatever the market throws at you. I think that the Fed is going to come out with perhaps an explanation on Friday saying how with their current commitment to keep rates low until the middle of 2013, effectively that frees up about $300 billion of their balance sheet to invest in longer-term securities. I think they're going to send a convincing message to the market saying that these long-term yields that are so low are going to stay that way for a while.
If you trade two-year treasuries right now for any desk, I think you can basically take the next 2 years off, right?
Pretty much, yeah, that's their plan.
He said we're not going to move rates for any of that time. Brian and Mark, thank you very much.
Thanks.
Thank you.
Just about an hour